Hello and welcome to the ASB Investment Podcast, the show that keeps you up to date on the markets and helps you make smart choices with your investments. These are entirely our own views and that of our guests. It's not investment advice, but we know plenty of experts at ASB that will be happy to chat if you need. Welcome to the latest edition of the ASB Investment Podcast. I'm your host, as always, Nigel Grant, and on our first episode of 2024, we're going to deep dive into the ever-changing landscape with respect to global events. It's good to be back in the podcast studio, and as we move through the year, we can't help but acknowledge that it will be shaped by various global events. It's been shaped, even to start the year, from geopolitical tensions, elections, through to technological advancements as well. So how can you, as investors, adapt and thrive in this environment? And today I have someone who'll be familiar to many of our listeners and someone I thoroughly enjoy chatting with, Mr. David Griffith from BlackRock. How are you?
I'm very good, Nigel. How are you?
I'm okay. Good to be back with you. Now, welcome back to our, at the time we were recording, well, it's sunny now, but the last 2 days...
It wasn't this morning.
It wasn't. It's been dreadful. Thanks again for joining us. Firstly, just to quickly remind our listeners of your role at BlackRock and particularly what you do for ASB, and then after that, the summer break. What have you been up to?
Right, yes. Okay, well, what do I do in my current role? So I'm currently head of solutions for Australasia for BlackRock. So in that role, my responsibility and my team's responsibility is to manage the ASB portfolios.
Yes.
And, as part of that, it's really bringing the best of BlackRock insights to bear on the ASB portfolios and getting the best outcomes for customers. And as John Smith always reminds me, David, you're on the hook for performance. So absolutely, we are very conscious of that, and just looking to see how we can maximize the opportunities from investment returns for the portfolios.
And the summer break?
So yes, summer break was actually really relaxing, I have to say. I had a really quiet, just a beach holiday with the family, lots of time at the beach, swimming, bit of Lego.
Yes, I was going to ask you about the Lego.
My eldest son, was starting, he's 15, but he's just starting to get into Lego now. So helping him with that. So that was a bit of fun.
Only Lego now?
Yeah, we had them, we bought lots of Lego when they were much younger and they didn't really get into it. We chucked a lot of Lego away.
Did you?
Yeah. And now he's like back into it. So, but I think the standard of the Lego that he's buying now is much more complex than the simpler
and stuff.
Yeah, it's more like, so what did he build? The DeLorean. Remember the DeLorean from Back to the Future?
Yeah, 88 miles an hour.
That's right. Yeah. Flux capacitor, all that sort of stuff.
Yeah.
And then what else did he was also making a really interesting choice. He got a Japanese garden.
The Zen garden.
And he was creating that. So it was really interesting, actually.
My nephew made the Zen garden at my house when he was up for Christmas break.
Oh, there you go.
And my beloved wife got me the orchid.
Oh, so you're into Lego as well?
Big Lego.
The orchid.
Big Lego fan.
Does that come with the Zen garden, does it? Is it like
I'd say add-on? It might be a portfolio enhancer.
Right.
Yeah. There's the dream Lego set for me currently is the giant crane, I think. And it's, I don't know, everyone's getting an insight into what I do here, but I think it's like 4,000 pieces. It's 1.5 meters high.
Wow. This is a crane for lifting things or
yes.
crane as in bird?
Yes,
crane
and
for
you can
lifting
control
things?
it from your phone.
Oh, is that right?
Yeah.
So it's automated.
Yeah.
Incredible.
So AI is everywhere.
Is that on your Christmas wish list for this year?
Yeah, it's on my slowly save and then eventually get a list. In my summer break, I did the gardening, as I said, I think put to end the year, but I also, probably more interestingly, just this weekend had the annual family tomato competition.
Wow.
Yeah.
Tell me more. Did you win a category? Or?
I did not.
Okay.
I won a couple of categories. My daughter was on my team, then she divested the family name and then entered with her friend, and she won best tasting and smallest red. I won most erotic.
Oh, really?
Yeah, which I won't go into the podcast, but fair to say it was, it's the glory category.
Right.
So that's an
annual
hot
competition for this category?
Oh, look, there was. It's hotly contested, but it's an annual tradition for my family, and look, it's a hallowed event in the calendar. Look out next year, listeners, when you see that I've reclaimed Supreme Grower.
This sounds like a whole new topic for a new podcast for you, maybe.
Yeah, well, I do hope to launch eventually a gardening/investing blog. So there's something there that if I can weave that in, that'd be perfect. So enough about that. It's a pleasure as always to have you here and have you back, obviously, this time. First things first, we want to get into, what do investors at all levels need to think about when world events occur? And I know we've touched on this subject in previous podcasts as a general theme. We know events are happening around the world, now and ongoing into the future. What are the key themes and trends that you guys are keeping an eye on for investors and potential impacts on your strategies and associated things in 2024?
Yeah, really good question, Nigel. Look, there's a lot going on, and I guess we're quite privileged within BlackRock. We've got a whole group that sort of thinks about this stuff day in, day out. So that's the BlackRock Investment Institute. I know we've spoken about the BII. Ben Powell, who's featured on these podcasts, sits in that team. Yeah. So, it's quite, it's excellent to sit inside BlackRock and just sort of listen to how they think and some of the thought pieces they write very topical thought pieces around certain market events and where the world is heading, basically, both near term and long term. And part of their role is to really think about the themes that may shape financial markets in the year ahead. So they actually formulate themes, every year. And I guess for 2024, they really formulated 3 key themes. I'll just run through them quickly. Managing macro risk, and I will explain what each of these are, but managing macro risk, steering portfolio outcomes, and harnessing mega forces.
Yes.
So just touching on each of them briefly. So what do we mean? Managing macro risk. I guess this is very topical at the moment. And it's all around the new regime that we think we find ourselves in. We think we're in this new regime that is shaped by supply. And that has implications. It has implications for policy rates and has broader implications on financial markets. So how is it different to the world that we have been in? So you think about sort of the world post-GFC, we call that environment the Great Moderation.
Yeah, we've heard that term.
Yeah, Great Moderation. This is where we had really stable GDP growth, really low inflation. Central banks are actually trying to invoke inflation using methods like quantitative easing and different policy to stimulate economies, to grow economies and get inflation back to where it should be, alongside the inflation target of central banks. We're now in this environment where it's completely the opposite, where we are shaped by supply. So economies, in terms of the operating capacity of economies, we think they're up against these constraints where the economy can't produce as much as what it was producing before.
To simply supply goods and services.
Supplying goods and services. They were part of that, and that's part of the reason why we're seeing high inflation. Part of that is a bit of the sort of the COVID lockdown and reopening story, but we do think there is a structural sort of backdrop now that's driven by some of these mega forces.
Yes.
You think about sort of deglobalization and the way the sort of trade is rewiring in the new environment. That's inflationary.
Yeah.
You think about decarbonization. That's also like an inflationary.
And is the gentrifying or whatever the term is of the workforce, is that one like
demographics? Yeah, exactly.
Yep.
Yes, exactly. So we've got an aging workforce.
Yep.
And you think about that is a real issue in terms of the productive capacity of an economy. If you've got less of a workforce in 5, 10, 20 years from now, it means that the demand for labor is really tight. Wage costs increase in that sort of competing environment. And that, again, is another inflationary force. It's one of the key metrics that, say, for example, the Federal Reserve in the US looks at is wage price and inflation.
And so does that feed into that steering portfolio outcomes theme, does it? Sort of that funnels into some of the rationale?
Exactly. So if you think about sort of where that leads to in terms of portfolio construction, and then the way to think about it is, so in this new environment, we're going to have a world shaped by supply. You've got all these sort of forces acting in a different way. And compared to the previous sort of Great Moderation period where central banks erred on the side of being dovish relative to neutral, so try to stimulate the economy, we think it's going to be the opposite effect where central banks are going to be more hawkish and want to be raising interest rates and have to basically live with a higher level of inflation because of these this structurally higher inflation environment. So what does that all mean? we think that the variability of macro outcomes is going to be higher. So before, in the Great Moderation, as the name suggests, you had things were very moderate.
Yeah.
Inflation wasn't really moving around too much. Growth was very steady. In this new environment, we think that it's going to be more cyclical. You're going to have higher macro risk. You're going to have greater dispersion between economies. You're going to have greater dispersion between different sectors that'll benefit from the new environment compared to sectors that may be impacted detrimentally. So in that environment, you really think about whenever there's macro uncertainty, that generally translates into market uncertainty.
Yeah, gosh, I didn't really realise what we had until it's gone. I want to go back to the moderation.
We all do. We all do. Life was easy. Like we had the rising tide lifts all boats. So again, policy was underpinning markets. Everything was rallying. And then it's a new environment. You have to be much more selective. And that sort of feeds into the next theme around steering portfolio outcomes.
Yep.
And really it's really about thinking a bit in a more granular way about your portfolio, not just sort of purely investing in, I'm going to invest in MSCI World Global Equities. I'm going to take market cap weights. Is there a better way? Are there going to be winners and losers from this new environment? And trying to harness and point the portfolio into more of those segments, sectors, economies that will do better in the environment ahead.
So if I can use one of my famous analogies, that sounds to me like going around the buffet counter and being more discerning on what you put on your plate.
That's I haven't thought about it. That's a very good analogy.
I've literally just thought about that.
That's amazing. I'm very intrigued about how your brain works, Nigel.
I look forward to seeing you play that back to me in months ahead. And because I know in our prep discussions here, you more sort of better or greater divergence between winners and losers. Is that a fair statement?
Yes, that's right.
Yeah. And so that then all forces you to sort of harnessing mega forces, I assume.
Yeah, so I think about this sort of near-term, as I mentioned before, challenges around what's driving markets right now. It's all very much policy-driven. What's, RBNZ, what's the outcome for interest rates, what's the outcome for the Fed and other central banks. And that's been a dominant driver of markets. Clearly earnings seasons, and we all, love talking about NVIDIA. We're just talking about it on the way in here and the earnings outcome there. So there's these sort of fundamental backdrop, which are more near-term outcomes that we need to be conscious of. But there is also these, longer-term structural forces, which we like to call these mega forces. And, one good example of that mega force is related to NVIDIA. It's AI. Yeah, and you think about the Magnificent Seven and what that's done to the S&P 500 and, those, large 7 stocks really driving all the outperformance.
Yes.
So thinking about in the period ahead, well, what's going to happen? Should you continue to invest just broadly in the S&P 500? How do you think about those 7 stocks? Are they overvalued? Certainly they're living up to their expectations.
Yes, they are. Yeah. But these are all secular change type things, eh?
Yeah, so these are a lot of these are having an impact in markets right now. We do think that the AI theme at the moment, those outperformers are really centered around those companies that have developed the AI technology.
Yeah.
But over time, the benefits of AI, we think, will broaden out. Will flow on. So if you think about the scenario where you've had, these 7 stocks just really going crazy and then the broader S&P 500 stocks kind of not doing too much, it may be that in the periods ahead, as AI starts to benefit those other companies, those companies will find productivity efficiencies, new ways of doing things, new technology that should aid those other companies and spur on their earnings growth.
There's for some reason, probably because I'm a gardener, I always think of Deere, right? Deere, the tractor, the massive tractor, CapEx company. I always think that, a couple of years ago, they launched their autonomous tractors.
Right. Okay.
And I always, that's for some reason, just because I like John Deere, I always go, that's an application. Like there's the technology being invented, but eventually, what's to stop all of this, my combine harvester, just being powered by AI?
Totally. Yeah. So like new economy affecting old economy and people, everyone benefits from that.
And just because I like to surprise David with facts that we haven't prepared for or anything, you don't have to do anything necessarily with this, but I found out this week related to demographic divergence, one of the mega forces, that Nigeria's population will be bigger than China's by 2100 through China birth rate, the decline.
Right.
But the sheer scale of population growth in Nigeria.
That's incredible.
Yeah.
I'm not sure I'm going to be around to see that outcome.
Neither will I. Neither will I.
That's pretty fascinating.
So in terms of what this all means, I guess if we distill it down before we move on to the next section, I guess how would you describe what that means for the individual investor? What these sort of three key areas, kind of what's the key takeaway?
Yeah, so I guess the key takeaway is timing markets is really hard to do. So if you think about sort of trying to time investor outcomes around, one-off risk events or FOMC decisions on interest rates or RBNZ decisions on interest rates.
Yeah.
These are really short-term events.
It's a trader's game.
It is. Yeah. And, I've seen that done well and I've seen that done very poorly, even for the professionals.
Yeah.
It's really, really hard to do is to time markets, which is actually why we diversify.
Sure.
It's the whole point around being diversified.
Yeah.
So, again, maintaining diversification, rely on the professionals that are managing portfolios, stay invested. I did this study a little while ago when we took the example of US equities and the S&P 500. And we looked at if you looked at the last, let's call it 24 years of returns every single day.
Yep.
And you just said, okay, what if you missed the top 10 days of those returns so if you look at the number of trading days in the last 24 years.
So Mondays to Fridays,
it's about 6,000 days.
Okay.
You just take away the top 10.
Yeah.
The impact on your cumulative returns is something like 120%.
Just by thinking you were smarter and not being
invested.
Yeah.
So think about your investment horizon, and if you have a long-term investment horizon, it pays to be invested and use compounding to your advantage.
Yeah.
Because it's really hard to time markets, and if you miss those days,
the data says
you're going to lose out.
Yeah. So it's one of those things like, don't just do something, sit there. It's the counter of what you think. Like, you should be doing things and everything. Don't just sit there and do stuff. It's actually sit in there.
I would say if you have skill in doing something, by all means, go and do it.
Yeah.
If you think you have skill and if you've evidence that you have skill, and that's part of one of what we do in terms of our role is finding managers that have skill in active security selection, for example.
Yeah.
And it's all about, again, we're going to get into the weeds now in terms of complex portfolio construction, but there's various, when you're managing a more diversified portfolio, you can find managers with greater skill because they've got a greater breadth of investment decisions. But actually timing markets is binary. You either get it right or you get it wrong.
Yeah.
And so for you to be successful in generating active returns from that process, you need to have a really high degree of skill. And the fact of the matter is there's not many managers in the world, professional managers that have skill in actually timing those short-term gyrations.
The market will do its work for you.
So you're better off taking, active risk in sort of more broader diversified areas of the portfolio than trying to time the direction of markets is what it boils down to.
I guess I'd summarize with, key things you have, structural conviction in.
Yes, that's right.
Okay, so we've talked a little bit about some of the structural changes, the things I'd say, almost like swimming with the tide, things that are happening. As we said in the intro, the last 12 months, there's been a lot of, continues to be volatility and events that are happening which make investors take pause and think. How do you generally deal with events like that when you're considering, portfolios and running money?
Yeah, it's a good question. Like, I guess the base case is there are always risks, sort of these known unknowns, right, when it comes to managing portfolios and investments. And the way we like to think about it is we just very, I guess, simply, we think about it in two broad categories. Things that you think you can forecast and things that, there's evidence of historical relationships and you can, with a high degree of, I guess certainty is probably too strong a word, but conviction that you know how markets may react to a certain event.
Yep.
So that's one group of I guess, event risks. Yep. And then the second group is things that you just really can't forecast. Either you can't forecast the outcome of the event and or you can't then forecast how markets react to that event. I'll give you two examples of each of those. So first category, things you sort of think you might be able to have control over, predict, and also think about and do something about a potential outcome. Go back to end of 2021, start of 2022, we had bond yields at all-time lows. You had sort of the confluence of COVID reopening. So we're all there tracking how many people are going out to restaurants and all these sort of things. And there's evidence of green shoots of economies reopening and what that might mean. Casting your mind back now. And when Chill did a podcast on that back in the day. there was a sort of these green shoots of inflation. Inflation was starting to increase, and I guess no one was really forecasting the levels by which it got to in the end. But you could piece that together in a fundamental way and look at valuations of fixed income markets where they were in the direction of, strong economic growth or recovery in economic growth and what that might do to inflation, and thinking about how you might want to position a portfolio.
Sure.
So that was an example where we did actually take action in the portfolio. We kept duration low, which is the portfolio's sensitivity to rises in interest rates.
Yeah, against the duration. Yeah, we talked about it in the past.
Yeah, exactly. So, essentially we were concerned about, bonds selling off. Bonds had just been on this rally for the last 15 years, reached an all-time low in yield.
Yes.
And this environment was turning where you were getting sort of, the growth turning around and green signs of potential inflation on the horizon. So we did position the portfolio, and that worked out really well in 2022.
And what's the counter event that you can't plan for?
The counter event, let's take the classic example that I like to use, which was the Trump election or the US elections back in 2016. So in the lead up to that election, there was a whole analysis. Everyone had different views around the outcome. The consensus view was that if it was a Trump win, that would be disastrous for markets.
Yeah.
No one really expected Trump to win.
No, they didn't.
So you think about the two things about, can you forecast the outcome and can you forecast the direction of markets or what the market outcome will be, even if you could forecast the outcome of the risk event. So that was a classic example where, we had best minds in the world looking at it, thinking about what the outcome might be. At the end of the day, the way we think about those geopolitical type events is we treat them as risk events, not alpha opportunities or active return opportunities. We think about them as risk events. And I guess one of the tools that we have in the portfolio is a risk mitigation process whereby we look at managing the total portfolio risk. And there's various mechanisms that we can use to bring risk down should we feel that there's an event that's not priced by the market. But trying to guess or trying to estimate what might happen to markets, that's a classic example where nearly every expert in the world both got the outcome of the election wrong and also the direction of markets wrong. I think markets dipped, on the day, but then recovered pretty strongly thereafter.
Yeah, that's right.
Yeah.
So global events are one thing, but within those events are also other decisions being made by governments and central banks. Well, not governments necessarily, but central banks are the ones that pull the lever, which is pretty much monetary policies or interest rates. So with views out there that inflation is well and truly peaked and heading in the right direction, well, the consensus view is that investors will be very interested to know what the path of policy decision is and forecasts around their rates. And obviously that always impacts into the main thing that people worry about probably is their mortgage or how it impacts their the assets that they have in their portfolios. So my question to you is, do our investors need to worry about this anymore? And is there anything they can use to their advantage?
Yeah, good question. I think as you say, you say inflation has peaked. And I guess the jury may be out on that, over the medium to long term. But yeah, look, I guess where's the status of inflation? I'll give a global / US, and we can talk a bit about, locally here in New Zealand. So in the latest print, I'm going to talk about US inflation. So the latest print for US inflation at the end of Jan was 3.1% for the US. So again, that was just, there was an expectation or a hope that inflation was going to have a 2 handle on it. Yes. So like a 2.9 or something to get down to closer to, the Fed has a 2% target.
Yes. Having
a 2 in front of it would have helped.
Yeah.
But that's down from a peak of 8.5% thereabouts. So, inflation has come down a lot. So I think the Fed is being cautious. They haven't claimed victory yet on it. You've still got core inflation. So everything about, headline inflation versus core.
Yep.
The difference there is that the core inflation strips out some of those more volatile elements.
Gas and food, I think.
Exactly. Yeah. Food and energy. So core inflation is still running at 3.9. And then you can also then decompose inflation a different way into services inflation and goods inflation. So goods inflation has come all the way down to the point where year on year it's basically
That's
flat.
My Lego, isn't it?
That's your Lego.
Okay, right.
That's right.
Yeah.
So if you want to buy some Lego, Lego's not going up, hasn't gone up.
Buy now.
It's pretty it's pretty flat year on year.
And services?
And services is sticky. And so services inflation in the US is still sitting above 5%. And that's the area where, the Fed and it's a very similar story in other economies where the services inflation is quite sticky.
Yeah, service-led economy.
Exactly. So, and what drives that? Wages.
Yeah.
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 So again, jury's not out yet in terms of, has the battle been won? And there's various sort of historical scenarios or episodes where you have seen inflation come down and then central banks cut rates too quickly. And then inflation rears its head again. So like central banks have sort of learnt from that experience, and which is why we have on the side of caution and keep rates sort of a bit higher for longer, making sure they've really won the battle before they cut rates.
Yeah, sure.
That's sort of our base case. Closer to home here in New Zealand, inflation's sitting around 4.7, down from a peak of 6.7. If you think about sort of inflation, not as fast, and it never reached the peak that US has come back down to 3 in terms of headline. New Zealand here still sitting at 4.7. Now, the interesting point is, again, here you can break it down into tradable inflation and non-tradable inflation. Yep. So think about sort of imported inflation versus homegrown inflation. And that homegrown inflation is running at 5.9%.
Yeah.
Right, which is sort of
wages.
Still very high, still very high.
Yeah.
Obviously, you've got migration, which is, there's juries out again in terms of whether migration is deflationary or inflationary. It has different impacts depending on the skill set of the migrants, etc.
Yep.
But look, the job is not done yet, which is why you're seeing some pundits out there calling for the RBNZ to raise interest rates again. Yeah. What's our base case? It may be that it just means that, any sort of expectations for rate cuts may be pushed out the horizon a bit further. We are seeing sort of growth slowing in the New Zealand economy. The RBNZ will be conscious of that. So it may well be that the cuts get pushed out further.
Cool your jets.
Yeah,
cool
exactly.
Jet.
Yeah.
Okay, so as we wrap up, what are your final thoughts, or what final thoughts do you have for investors navigating all these complexities for 2024?
Yeah, look, I would stick to the mantra of stay diversified, stay invested for the long term. Again, compounding is your friend, and I guess leave investment management to the experts. It's hard to do at the best of times, but it's really a long-term game. So I'm really thinking about your objectives and your investment time horizon, and making sure you're picking investments that suit those objectives.
And we go to the I was going to say we go to the scorecards, but that's a different sport. We go to my final question. So as listeners should know by now, the reading, watching, listening, or something else you've been doing that you can recommend? I'm
going to give you a bit of a different answer because I'm pretty boring when it comes to, we've had this conversation.
You're
I don't
not.
read a lot of books and I don't watch a lot of movies. But I tell you one interesting thing that relates to some of the themes, and this is going to be a bit geeky maybe, but I've been trying to just use a bit of AI technology.
Have you?
Yeah, in the day-to-day work. So we've just ruled, I'm not sure whether again, this isn't being sanctioned, but hopefully I can talk about this. But we're starting to pilot some AI tools within BlackRock. And so we have one application that we can start using, and actually used it in the formation to write my notes for this podcast, actually.
Did you?
I did. I loaded up. Yeah, so we have our BI outlook that we talked about. It's 15 pages long.
Yeah.
I loaded that to something called Copilot, and I asked it to summarize it in 10 bullet points or less using casual language.
Am I talking to a robot right now?
You are talking to a no, but again, coming back to that point around use of AI and broadening out, we are actually starting to use it in areas that are finance related.
Yeah,
and just making our sort of day-to-day lives easier.
I think that's one of the key things about it. Like there's a lot of hyperbole and talk about it. News articles, magazine articles, but when you hear stories like that where we are using this to make us more productive, it's here, it's happening.
It's
a
here,
thing.
Yeah. Like there's different things. Like I've heard of other companies using it for like marketing.
Yep.
Thinking about you want to get a graphic rather than getting actors and taking a photographer. Yeah. You can actually instruct AI to build the picture for you.
I wonder if you could get AI to be a podcast host. I'm starting to get really concerned here. You might just be talking to yourself next time. Well, thank you. I really, that was a great one to end on. And you're not a geek, because I confessed on this already that I want to buy the Lego crane. Okay,
right.
So you're amongst...
So you're top of the stack there in terms of the geek list.
I don't know if I'm top, but I don't know if I'm top of the geek list, but all I would say would be you've got good company.
Right, excellent. It's nice to be in good company.
So we've reached the end. Thank you for your expertise and sharing the studio with me today, David, as always. And thank you to our listeners for tuning in. Remember to stay informed, stay diversified, stay ahead in your investment journey. And until next time, happy investing and bye for now. Thanks for listening to the ASB Investment Podcast. If you have any thoughts on this episode, or if there's anything you'd like us to discuss on a future show, get in touch with us at podcasts@asb.co.nz.